Hello, my name is Anthony Verni. I'm an attorney and certified public accountant. I would like to speak to you today about offers and compromise and much of the confusion that has ensued as a result of television and radio advertisements. What is an offer and compromise? An offer and compromise is an agreement between the IRS and the taxpayer where the IRS agrees to take less than the face amount of the tax due, together with interest and any penalties, from the taxpayer in exchange for releasing the taxpayer from any further obligation with respect to that particular tax year. Contrary to public belief, the offer and compromise program is not a negotiation between the taxpayer and IRS, but rather a resolution process based upon objective criteria. Don't be fooled by advertisements suggesting that you can settle your tax debt for pennies on the dollar. This is simply not the case. Eligibility for an offer and compromise is based solely upon collectability, which involves a number of factors. First, the taxpayer must determine the excess gross monthly income over monthly allowable expenses, the result of which is considered to be the taxpayer's available income. It should be noted that some expenses may be limited to the national standard, which are predicated upon household size and geographic location. Second, you must determine your net assets, and in doing so, must calculate the gross assets less any outstanding secured debt. Third, a determination of the time period remaining under the statute of limitation for collections must be made. Once you have gone through the three-step process, the total monthly available income is then multiplied by 12 months and added to the total of net assets. This total represents the minimum amount of the offer, but the analysis does not end there. The minimum offer must be measured against the remaining period under the statute of limitations. Furthermore, in certain situations, the statute of limitations may be suspended. For instance, where a taxpayer has filed a bankruptcy, or where a taxpayer was previously deemed as uncollectible by the Internal Revenue Service. These events will cause the statute of limitations to stop running. In addition, the IRS will look at your installment payments, such as automobile loans, school loans, and other installment agreements, to determine the last payment date and whether that would result in additional available income. For instance, a taxpayer has an automobile loan that is set to expire in year 2 of the statute of limitations. The IRS, in this case, would determine that at the end of the 2-year period, the taxpayer's available income would be increased by the amount of installment payment that the taxpayer previously made with respect to the automobile loan. Generally, the IRS will not accept an offer and compromise if you can pay your tax debt in full through an installment agreement or a lump sum over the remaining period under the collection statute. This third factor is often overlooked by tax practitioners and tax resolution companies. This is why you need a tax attorney. There are also other requirements. Before the IRS will consider an offer and compromise, you must do the following. Number 1, you must file all your returns that are legally required to be filed. Secondly, you must make all required estimated tax payments for the current year. And 3, you must make all required federal tax deposits for the current year if you are a business owner. If you are eligible, the IRS will require you to complete and submit Form 433A, Collection Information Statement for Wage Earners and Self-Employed, and Form 656, known as the Offer and Compromise Form. In addition, if you have an interest in a business entity, You must also complete Form 433B, Collection Information Statement for Business.